Hi, this is Jay with eXp Realty, and I just wanted to introduce myself so you could kind of put a face with the name and, see that I'm a real person and know that I'm a real active agent just like you. And I thought I'd share this information because it's been so helpful for me in my real estate business. It's helped me stress less and just feel more in control of my business. And I thought that by sharing it and just kind of paying it forward, that it would really be helpful for a whole lot of agents. And I wholeheartedly believe and understand that, the only way that I'm going to get ahead is to help enough other people get what they want first. And I think we're all pretty similar in the fact that we want to get ahead. We want to be able to, take care of our families, take care of ourselves, and just have some more time to enjoy life without stressing about money or the bills or our next closing or, all the things that we don't have yet. And I think that's really why we probably all got in the business to begin with anyway, right? It was to get ahead a little bit. So that's what this information is about, and I hope you enjoyed what I'm about to share with you. And if you have any other questions, please feel free to give me a call. So we all need some basic financial intelligence training, right? I mean, just think about it. We all have to make money and pay our personal bills, but as realtors, we also have to set aside money to pay our business overhead too. Then we still have to pay our regular expenses like going out to eat or to the movies or putting our kids into soccer, and all those things aren't cheap either. And then after all that, we need to set aside money to pay our taxes and reinvest in our business. Then to really pile it on, we still need to save money for our future, for retirement. And how are we supposed to do all this without a regular paycheck, just on commissions? This is the reason we put together Agent Fit, to discuss financial issues that we all face as agents in the real estate business. And I'm going to show you the best solution that I've found and that I'm actually using to get ahead financially. It's like having a savings account that is making a guaranteed 5% ROI year after year. And as far as I know, right now in a savings account or a CD, the best you're going to get is still under 1%. And in a nutshell, the problem with money boils down to this question: how can I save money for the future when I have things that I need to pay for right now? Usually we see this as an either or situation, and that means we have to decide between using our money or saving it. What we're going to see today is a way to create a both and situation for ourselves. Imagine if we could pay off $3,000 in credit card debt and end up with $3,800 in our bank. Plus still have access to this money in case we have a future emergency, so we don't have to go back into debt and put more money on our credit card after it's already been paid off. What if we had our own family bank, so to speak? And by the way, I'm not an expert by any means, and if this overview makes sense, and I'll get you in touch with the most knowledgeable person I know on this subject. And full disclosure, I'm not making anything by sharing this information, and honestly, I'm not really sure why this isn't much more commonly known or used. And I hope that by introducing this to you, that you'll start to know me, trust me, and like me enough to hear out some of the other ideas that I'm using for lead generation and business building. And I'm also not a financial planner or a CPA either. I'm just a real estate broker that was looking for a better way, and this is what I found, and this is what I'm using. And I think it's such a powerful tool for realtors that it's worth sharing with you and every other real estate agent out there that I can connect with. And the main purpose of this is to shed some important light on the financial headwinds that we all face, because by knowing more and being better educated, we have the opportunity to make decisions that can really help us get ahead financially. See, we, meaning most of us, are independent contractors, which means that we wear a lot of different hats, and that makes it difficult to focus on other areas like lead generation or customer service or building our business. And it can all become very overwhelming, and this is a chance to cut through all the noise and simplify the way we think about our money. And I don't know if you're aware, but the 2017 NAR president, Bill Brown, made it one of his main areas of focus to help real estate agents understand what it takes for us to retire from real estate. And he says sometimes agents will work in this industry and be really successful for 15 or 20 years and still leave with nothing. So imagine that, after 20 years, no gold watch, no 401k, no nothing. And I know we've all seen agents that have been in the business a really long time, and they're still putting signs in yards, and they're giving up their nights and weekends for showings because they can't stop. And honestly, for most of us, if we stop selling houses, we stop making money, period. And that's what we call the realtor paradox. And the paradox is if we don't get enough leads, then we're out of business. And if we get too many leads, then we tend to burn out of the business because we end up working 60 to 80 hours a week, tied to our phone and our computers on nights and on weekends, and really not having a life outside of real estate. So we're damned if we do, and we're damned if we don't. And just to quickly let you know that Agent Fit is financial intelligence training for real estate agents. And we're going to cover other topics on lead generation and credit and debt reduction and business building also. In this Agent Fit overview, this is what we're going to cover. The 3 rules of money and the general way credit is used. This way we can get a better understanding of the problem. Then we're going to uncover some solutions and give some examples comparing traditional methods with our approach. And in this overview, we won't go into too much depth, but I'm more than willing to talk with you afterwards and iron out any areas of details where you'd like more information. And overall, it's going to take 25 to 30 minutes or so you can watch the entire video. But if you don't have time for that, or it's going to be easier for you to watch it in smaller chunks, you can watch each episode individually, and you can do that by clicking on the links in the description of this video below. Episode 2, the 3 rules of money. In this episode, we're going to go over the 3 rules of money and why they are so important. The rules are simple. Keep some of what you make, have a plan to put your money to work for you, and don't lose your money. So let's dive in. Rule number 1 is keep some of what you make, and basically that means to save your money. So what's the difference between making a lot of money and being wealthy? The difference is income is measured in dollars and wealth is measured in days. And the reason I'm bringing this up is because in the real estate industry, all the training and all the coaching is focused on increasing our production so we can have more closings and in turn make more money. And that's fine until we realize that in order to accomplish this, we need to spend more and more money and more time to do it. So why is none of the training that we get based on how to save more of the money that we've already earned? Let me give you an example with 2 of the richest men in American history, Cornelius Vanderbilt and Mayer Rothschild. Vanderbilt died in 1877 with a fortune of around $105 million, which is like being a mega billionaire in today's dollars. He left $1 million to the school, which became his namesake, Vanderbilt University, and he left the rest to his family. Now, almost 100 years later, the Vanderbilt family had a reunion, and out of 120 of them, not one person was a millionaire, and all the money that he left behind was gone. Now, let's look at Mayer Rothschild. When Rothschild died in 1812, he didn't have near as much money as Vanderbilt, but if Vanderbilt was a mega billionaire by today's standards, then Rothschild would have been like a comfortable multimillionaire. But instead of leaving money to his family, he left them a family banking system instead. And the system had 3 parts. 1, the money had to be kept together in one family bank. 2, any family member could take a loan from the family bank whenever they wanted for whatever they needed, but they had to pay the loan back. And 3, the family had to meet once a year to learn from each other and see what was working and what was making money and what wasn't. And if you didn't make the meeting or if you didn't follow the other rules, then you were no longer part of the family bank and you lost access to the money. If we fast forward, currently the Rothschild family fortune is worth over $1 trillion. Yes, that's trillion with a T. Now just think about that. Vanderbilt lived longer and he left his family a whole lot more money, but over the same period of time, one family spent it all and the other family grew the fortune even larger. See, it's not about how much we make, it's about how much we keep. And I think we're proving our point here, right? We have to keep some of what we make. But what are we trained to do in real estate? Are we trained to keep our money, or are we trained to sell more and more houses so we can make more money? And I think we all know the answer, especially if we haven't heard of this family banking concept before. We're trained to sell more and more houses, not keep more and more of our money. And so what's the difference? The bottom line is that the only difference is one family had a plan for their money and the other family didn't. So that brings us to rule number 2. Have a plan to make your money work for you. See, they say that money is a good slave but a bad master. And at one time, 50 Cent was the business partner of Floyd Money Mayweather. And he described Floyd's business plan as this. He said, he fights, he gets paid, he spends the money, he fights again. He fights, he gets paid, he spends the money, and he fights again. Now, Floyd makes millions and millions of dollars on a single fight, plus he he's a boxing promoter, so he's kind of double dipping. But every couple of years, he has to fight again because he's running out of money. And eventually, I think we can all see that he's going down the same path as the Vanderbilts. And eventually, he's going to hit a point in his life when he can't fight anymore. And then what's going to happen to his income? And how does all this pertain to us as realtors? Well, see if this sounds familiar, right? We sell a house, we get paid, we spend the money, and we sell another house. We sell a house, we get paid, we spend the money, and we sell another house. See, eventually, we're not going to want to sell houses anymore, or we're not going to be able to sell houses anymore. And if we don't have our money working for us, then what's going to happen to our income? And I think by now we kind of have a better grasp on the idea that making more money isn't necessarily the best answer and shouldn't be our focus as much as keeping more of our money and putting that money to work for us should be. Rule number 3, don't lose money. Now, to get to this point, we've already had to follow the first 2 rules, and we've managed to save some money and make it work for us. Now, after all that, we don't want to just give it away to taxes and fees and risky investments, right? Well, let me ask you this. Right now, what is your largest expense? Well, if you said it was taxes, then you would be correct. So think about it. When we buy something at the store, we pay a sales tax. When we buy a new car, we pay tax, title, and license. When we put gas in the car, tax is already built into the price that we're paying at the pump. And what about our house? Even if it's 100% paid off, we still have to pay taxes every year to keep it, or the county's going to put a lien on it and eventually they're going to take it from us. So here's a great visual to show the effects that taxes have on our income. So imagine if you took a job that paid just 1 penny for a day's work, but the amount you earned would double every day. I guess the first question would be, would you take that job? So here's what it would look like. So day 1, you earn a penny. Day 2, 2 cents. Day 3, 4 cents. Day 4, 8 cents. Day 5, 16 cents. And so on for 28 days. So do you know what the total would be after 28 days? Well, on the 28th day, in total, we would have earned over $1.3 million. Now that's a lot of money, right? So now, side note, who would take that job? Right? I think we all would. Well, and that's the power of compound interest, and that's what Albert Einstein called the most powerful force on earth. But like I said, that's just a side note to the overall conversation. So now let's take a look at the effects that taxes have on our income. So we're going to have the same scenario, but in this case, we're going to have to pay our taxes first, just like we do in real life. So we're going to pay our taxes first at the end of each day, and then double our income, and then see how much the total is after 28 days. So how much do you think that would be worth after the same 28-day period? Well, instead of over $1.3 million, we would end up with only $88.20. I know, right? That's a crazy number. That's a huge difference. And that's the difference between being able to retire comfortably or just barely being able to afford a dinner and a night out or a movie, right? And this is where it gets crazy. So I hope that this illustrates the effect that taxes have on our income and what effect they can have on our ability to get ahead. So remember, we need to pay our taxes to be compliant and follow the law, but we don't have to overpay our taxes. And most importantly, because we want to follow rule number 3, we want to be as tax efficient as possible so we don't lose money when we pay our taxes. Episode 3, credit. So how would you like to give yourself a 50% raise? That would be like if we sold 10 houses last year and made $60,000. Then we sold 10 houses again this year, but we made $90,000 instead. Well, the amount of interest we pay is another financial headwind that keeps us from getting ahead, and I'm sure we'd all love to make 50% more money for doing the exact same job we're already doing, right? Now we're going to talk about credit and how to actually create this 50% raise for ourselves without waiting for our brokers to give us a better split and without increasing the number of clients we help or the houses that we sell. And I know this can be scary because it removes the traditional obstacles and leaves it squarely on us. But it only takes understanding this information that we're about to cover and taking action to implement it. See, the average person spends about 50% of what they make paying down their debts each month. And most of that, about 34.5%, is going right out the window just to pay interest. And these are after-tax dollars also. So it doesn't matter how much money they make either. Remember rule number 1? We have to keep some of the money that we make. Well, this is another example of that because the ratio is about the same regardless of what the person does for a living or how much money we make. For example, an apartment maintenance man making $25,000 a year would spend about $12,500 a year on debt service. That means paying his mortgage, paying his car payments, paying his credit cards, and other loans that he has. And about $8,625 of that is just going straight to pay for the interest. It's not even reducing the balance that he owes. And that's one end of the income spectrum. Now, what if we had an attorney making $100,000 a year? Well, it's pretty much the same. He'll spend about $50,000 a year servicing his debts and about $34,500 a year just paying the interest on those debts. So the remaining 50% of their income is what they use to pay for their lifestyle. That's what type of house they own and what kind of neighborhood they live in, what kind of car they drive, what type of places they go out to eat, what kind of clothes they wear, what type of vacations they take, what kind of schools that their kids go to, and on and on. So if each of them would pay off their debts, then it would have the same effect as getting a 50% raise and having 50% more money to make those lifestyle choices with. So when it comes to interest, what's more important? Well, it depends on if we think like a banker or if we think like a borrower. So let me explain. See, as a borrower, what's more important to us? The interest rate and the monthly payment that we pay, or the amount of dollars that we're going to pay in interest? And on the flip side, what's more important to the banker? The interest rate that they give us and the monthly payment that they give us, or the amount of dollars that we're going to pay them in interest? See, bankers understand that it's about the amount of dollars we pay, not the interest rate that they give us. Let's look at an example of how we spend money on cars. That way we get an idea of the amount of money we spend and where it goes. See, there are only about 3 ways that we can buy a car. One way is debt. We can borrow the money and pay interest on the loan. That's the method most of us use. Or we can save and then use our cash to buy the car. And we'll save some money by not paying the interest, but we lose the ability to have our cash working for us. And remember, that violates rule number 2 about money. So the third way is to use our own family banking system, just like the Rothschilds did. So let's check out this example chart using debt to buy the car. So the borrower is going to get a loan and they start out $25,000 in debt and pay $5,000 in interest just for the pleasure of having that debt. And then in 5 years, they end up back at zero with a 5-year-old car. Now in the cash example, the saver that bought with cash, they maybe end up a little bit better off because they didn't have to pay any interest, but they still had to pay themselves $500 a month for 5 years to save the money that they needed before they could buy the car. And we can see this in gray on the left side of the timeline. See, but he still needs to, or he still ends up back at zero as soon as they purchase the car. So either way, they end up back at zero at the same place. So after 5 years, whether they saved and bought with cash or borrowed and paid interest, they both end up with a 5-year-old car and nothing in the bank. So who was the real winner here? So what about the bank? How did they end up? Well, let's take a look at that because this is the part that most of us just don't think about. See, the bank basically acted as a middleman between the debt buyer and the cash buyer. When the debt buyer comes along looking for a car loan, the bank takes the money that their cash buyers have been saving and then they loan it to the debt buyers, with interest, of course. So the bank is making money from just being the middleman in this financial transaction. Well, what if we were the middleman in this deal? How would that look for us? Luckily, that's exactly what we're learning how to do, and here's a chart of how that would look if we used our family banking system. So we buy the car for $25,000 just like everyone else, except now we're becoming our own banker and putting ourselves in the middle of the transaction, because when we take the loan of $25,000 from our bank to pay for the car, we're like the cash buyer. And then when we pay off the loan at $500 a month for 60 months, we're just like the debt buyer. And now, here's the magic part. Because we're also the banker in this transaction, we're going to continue to earn interest on the $25,000 that we loaned ourselves, plus we're going to recapture the interest that we would have paid as the debt buyer, which was $5,000, remember? So how do we end up? Well, let's take a look at the results of each method after buying one car. So in option one, we use debt. We spend $30,000 on a car and we end up with zero in our bank account. Option two, we use cash and we spend $25,000 on the car and we end up with zero in our bank account. Same place. In option three, we're the family banker and we spend $25,000 on the car just like everyone else, but we end up with $36,907 in our family bank account. So which is the better option? Well, if you're still not sure, it gets better because this is just the tip of the iceberg. See, if we had a couple of closings that went bad, and let's just say that one deal we had a buyer that gets denied at the last minute because they went out and they bought furniture before they closed on the house. We all know how that ends up, right? Now they can't qualify, so the deal never goes through. And then our other deal had some last minute hiccups, but it wasn't that dramatic, so that one just got pushed into next month to close. But we're still counting on that money for this month, right? So now we're in a tough spot financially. Well, then, if we use the family banking option, we can just decide to skip our car payment if we want to, and there won't be any stress or worries because there won't be any penalties, there won't be any late fees, no harassing phone calls, no drop in our credit score, none of that. In fact, all we have to do is start paying again the next month or the month after, whenever we're ready to get it going again. See, the family bank is just a way to finance all the things that we're going to buy over our lifetime, but instead of sending that money out to Visa or MasterCard or Ford Motor Credit or wherever, what we're doing is we're sending that money to ourselves and then we're recapturing that money in our own private banking system so that we can use it again later when we need it. And just to make the point clear, after knowing what we know now, is this about the interest rate or about the amount of dollars we pay? And again, this depends on whether we're thinking like a banker or thinking like a borrower. And to be honest, if we're the banker and the borrower, then it almost doesn't matter how much the interest rate is or how many dollars we pay in interest because we're going to benefit and come out ahead either way. Episode 4, Creating Our Own Bank. So this gives us a good idea of the problems that we already know we're facing, right? And maybe we didn't look at them quite this way before, but we know that they're there. They're like headwinds that are blowing us backward and keeping us from getting ahead. So what's the solution? Well, we've already kind of touched on it with our family bank, but first let's take another look at how traditional banking works for us as real estate agents. So remember, we sell a house, we get paid, we spend the money, and then we go sell another house. That's the typical cycle, right? So when we sell a house, we've done our job and we've worked through the issues, negotiated all the obstacles, and after 30 to 90 days or so, we have a closed transaction. Then we get paid, and where does that money go? That goes into our bank account typically, right? Then we spend the money out of our bank account, and then we go do it all over again by selling another house, right? That's a typical cycle for us. So when we spend the money, this is the critical step, and this is where I want us to focus our attention. So remember that half of the money that we make is going to pay for the things that we financed, like our credit cards, our cars, our houses, those types of things. And where did we get the money to buy these things in the first place? Well, typically we borrowed it from the same banks where we cash our commission checks. So whose money are we really borrowing? Yep, you guessed it. We're borrowing our own money. So the question we need to ask is, what do banks do? And the answer is simple. They take deposits and they earn interest by providing loans to us. Okay, now let's put this in the context of creating our own family bank. See, there are a lot of places that we could put our money to build wealth, and they each have their own set of pros and cons. But what if we had our own family bank? Wouldn't that be great? And what are the features and benefits that we'd want our family bank to have? So what if, when we needed the money, like to take a car loan, it was simpler and easier to qualify? In fact, what if there were no qualifications, no credit check, no penalties, no applications at all? It was just like getting money out of our checking account or savings account. We would just need to request the amount that we want. And what if our family bank had guaranteed growth, like with bonds or CDs? What if our family bank offered tax-free growth, like with a Roth IRA? What if our family bank was protected from creditors and judgments, like 401ks and IRAs? What if our family bank, we could pass on assets with no probate, no income tax, and no estate tax, like with some trusts? And what if our family bank could create a legacy and leave money to our family when we died, like with life insurance? So imagine if we owned the bank. We could just borrow money when we needed it and then pay ourselves back. We would be capturing the interest that we're already paying out to somebody else, and we're still able to have the things we want. So remember, this is a both and situation. We get to have our car and gain the interest on the money that we used to buy it. So how could we create this family bank for ourselves? Well, the good news is that this concept has already been around for centuries, and it's survived through Great Depression, the World Wars, multiple stock market crashes, and the Great Real Estate Recession and mortgage meltdown of 2008. So what is it? It's a properly structured, dividend-paying whole life insurance policy with a mutual life insurance company. Now, this is the exact way to describe the family banking system that the Rothschilds had, and that we've been talking about here, and that we're probably going to want to create for ourselves. So it does come with some warnings, so the first warning is this is not something that you can, or that we can put together at New York Life or AIG. It has to be done with a mutual life insurance company. And this is not something that our friend in the insurance business can do for us either. It needs to be properly structured to work the way that we want it to and need it to. And this isn't something that can be done with universal life policy or some other hybrid that's tied to the stock market. There are only a handful of insurance agents in the country that know how to set these up correctly, and they should come with an IBC practitioner certification, and they should have at least one active policy themselves and be willing to share that policy's performance with us. Episode 5, Either or versus both and. Over time, most of the financial choices we make are either or decisions. So if we save $1, then that's $1 less that we can't spend. Or if we spend the $1, that's $1 less that we can't save. So either way, if we pay $100 to our credit card, or we can save that $100, but we can't do both. So we have to decide between using our money or saving it. And it's important to understand that we finance everything we buy. So we typically have two choices, either cash or debt. And we can use debt and pay somebody else interest, or we can use cash and give up the interest that our money could have made. So I think it's safe to say that most of us will buy a new vehicle every 5 years or so, right? And cars are tangible, and we could see ourselves buying multiple cars over our lifetime. So I want to use that as an example. So here's what we're going to do now. Let's look at how we would end up financially after buying 5 new cars over the next 25 years, using each example of the traditional debt method, the cash option, and our new family bank option. So if we buy 5 cars, the exact same car for the exact same price in each scenario, here's how it ends up. So option 1, with the traditional financing method, we pay $25,000 for the car, plus we have to pay interest. So that'll probably end up being about $5,000 or a $500 a month car payment. So we end up in total paying $30,000 for the car. And then in 5 years, we pay off the car, and then we do it again to buy our next car. And then 25 years down the road, we will have bought 5 cars. So how do we end up? So we end up with $150,000 in the hole, and all we have to show for it is a 5-year-old car. So option number 2, the cash method, it's a little bit better because we don't pay any interest, but the car payments never really go away, because as soon as we buy the car, then we have to start saving that same amount that we would have been spending on a monthly payment. That way we have the money ready to buy our next car in 5 years' time. And if you look at it, we're still not gaining any interest on that money that we're saving in the bank because they just don't pay that much. So we're still breaking money rule number 2. So we do this for the next 25 years, and we end up a little bit better because we've only spent $125,000 on the cars, but we still end up with 0 in our bank account and $125,000 in the hole and a 5-year-old car. Option 3. Now let's look at the family banking option. It works very similar to the previous method, and we only pay $25,000 for the car because we don't pay any interest. Now here's where it gets good for us. Our $25,000 is put to work 2 times for us. Once to purchase the car, and once again in our family bank earning interest for us over the next 5 years. So now we're still going to pay our family bank $500 a month because we have to pay our loan back, just like we do with any other option. But unlike those other options, who owns our family bank? That's right, we do. And so who's getting the benefit of those interest payments? That's right, we are. So in 25 years, how do we end up? Well, we will have spent $125,000 and have a 5-year-old car, and we'll also have $131,709 in our family bank. And we can use that for our next car purchase, our retirement, our next trip, or whatever we want. So if we compare the end results after 25 years, option one, the traditional method that most of us are used to, we borrow the money, we'll end up spending $150,000 on cars, and we end up with $0 in our bank account. In option two, we save the money and we buy our cars with cash, so we'll end up spending $125,000 on cars, and we end up with $0 in our bank account. Same place, right? In option three, we spend $125,000 on cars, we end up with $131,709 in our family bank account. So which is the better option? Episode 6, Endless Possibilities. And just so we're all on the same page, the family bank option is limitless, but let's take a look at how it can directly affect our real estate careers. So for this, I'm going to assume that we all want to remain in the business for at least another 10 years, and to do that, we have to stay current and compliant with the National Association of Realtors, the State Association, in my case that's Texas, and the local board of Realtors, for me that's the San Antonio board. So plus, we also have to pay our quarterly MLS dues and keep current on our license via paying for continuing education courses and license renewal fees, all that kind of stuff. So in my area, this is around $1,500 a year, give or take. So in scenario one, this is the way most of us do it right now. Anyway, we make a commission and we use part of that commission to pay the fees, and we repeat this process as fees come due throughout the year. And this is pretty much the way that we all do it now. So let's look at that over the next 10 years in the business, right? So we're going to spend about $15,000 and we'll end up with $0 in our bank account, but we have an active business. Right? In scenario two, we make a commission, and instead of paying the fees directly to these associations and groups, we're going to pay these fees into our family bank. Then we take the money from our family bank and pay it to these associations as the fees become due. So we're going to do that all year long. Instead of paying directly from our normal bank, we're going to pay it from our family bank. So at the end of 10 years, we still end up spending the $15,000, but we end up with $6,318 in our family bank because we put that $1,500 a year to work, and it's earning interest for us over that time period. So see, the point is that we're going to buy the cars and we're going to pay the fees to keep our license active anyway, right? So why not do it in a way where we end up with more than we started out with, and then we'll have enough money to buy another car or keep our license active for another year. And really, if we play this out long enough, in about 12 years, we'll earn enough money just on the interest to pay for these business expenses. So imagine that, having $0 out-of-pocket expenses, and then every dollar that we make is profit and just adds to our bottom line. So can you imagine what life would look like in 10 years on a day-to-day basis if we started doing this today? And if we really think about it, I'm sure we can get pretty creative with other ways to use our family bank, right? I mean, what if we did this to pay our taxes, or to put our kids through college, or to pay for our next vacation? Or even better, what if we did this to pay off our house and then showed our clients how they could do the same thing? I mean, do you think they would become, or we would become their realtor for life at that point, and then they'd want to tell their friends and family about us? I mean, I think so. And what does it take to start our own family bank? Well, all we need to do this is just what the bank does, which is take deposits and then earn interest on our money as we lend it out to ourselves. And all we need to do to set this up is to have a properly structured whole life insurance policy that we can make deposits into. Then that money will work for us risk-free, earning compound interest from a guaranteed rate of return. And then we can use this money to buy the things that we want and need during our lives. Pretty simple. Well, I hope you enjoyed getting this information and that you're starting to see some of the possibilities. And I'd love to hear some feedback from you. What did you think? What did you like? What other questions do you have? And you can just call me or text me and we can talk a little bit more about it. And I'll be happy to get you in touch with the expert that put my family bank together too, if you'd like. Thanks, and I hope to hear from you soon.